Hello, everyone. My name is Michelle.
Hey, my name is Tyler.
And I'm Mike Miller with Alliance West Mortgage.
Yes, so we are with a Coldwell banker,
Yes.
and I have been in the business for 16 years, and Tyler has been in the business for 4 years. He got his license just last year.
Yep.
So, and we have an entire team to work with. And today we have such a great honor. Today is Friday, August 5th, and I know the market has been changing so much. So today we have such a great honor to have our senior loan officer, Mr. Mike Miller, to share his expertise and his prediction, his observation, and with all this lending situation and real estate market with all of us today. And we have a Q&A because we got a lot of questions coming from all different clients. So Mike, I turn the camera to you, have you to introduce yourself.
Thank you, Michelle. Thank you, Tyler. Yeah, pleasure to do this for you guys. I been with Alliance West Mortgage for several years, been in the lending world. I actually started in real estate in the late 80s. So I've been around for a few changes and a few market fluctuations and things like that. I'm here to help and to provide information about the market.
Awesome. And
Great.
you have been seeing this for how long again?
I'm sorry, what's that?
You have been seeing this finance stuff, mortgage stuff.
1987.
Wow.
Been a while.
Have you seen like this?
Been a while. The gray hair is actually real. It's not just dyed hair.
So every era is all different situations. So now let's dive in for this current market.
Sounds good.
So I have the first question, a very simple question. I'll come from some of our clients. Why did our government, our Fed Reserve, increase the interest rate?
The increase of interest rate, the Federal Reserve uses that as a tool to try and either tame or bring back inflationary times. So when inflation is running hot, where the economy is doing well, and you've got cost of goods going up, things like this, demand at a very high peak, people spending money, they use that tool of raising interest rate or cost of money to be able to bring the inflation numbers or those higher cost items back down. As the cost of money goes up, it slows people's spending. And when they slow that spending, it slows the economy and therefore reducing the inflation rate.
Awesome. Thank you very much for that.
Thank you.
So our next question would be, what is the difference in interest rate and annual percentage rate?
So the difference between interest rate and APR, annual percentage rate, is the cost to either get that rate or the cost associated with that loan. So if you were to look at a no-cost refinance per se, no-cost refinance that they were advertising 3.5%, and with a 3.5% APR, that means that the borrower has literally no additional cost. All of the costs associated with any escrow, title, things like that are covered by the lender, and they're delivering a 3.5% rate. If you look at something where they have a 3.5% rate, but a 3.75 APR, that quarter of a point difference is the cost to get that loan, whether it be in discount points, escrow, title, lender fees, amortized over the life of the loan. And that equates to an APR.
Great.
Awesome.
Thank you. Thank you, Mike. And number 3, the question. In this current market, right? Pretty much we have the first quarter, second quarter. Now we are into the third quarter. But this is such a challenging market. How can we help our buyers? How can we guide our buyers in this current market?
Well, I think that, with volatility in mortgage rates and cost of borrowing, it's difficult for borrowers because sometimes, on a Monday, they can get a rate of, let's say 4.5%. On Tuesday, it's 4.75%. And on Wednesday, it's 4.125%. So it's very volatile from that respect. I think what they need to do is they need to work with their loan advisor, get a game plan in place as far as where their approval is, and have some flexibility on what the interest rate is going to do. Until they get into escrow and under contract on a property, they aren't typically locking because we don't know the duration of the escrow, and the lock period is how it would play out. So once they're under contract, then you can lock for 30, 60, 90 day, whatever that number is, position to protect that rate. And they then at that point have a definitive figure as to what their housing cost might be. Up until then, they should just stay in contact with their lender or their loan officer to make sure that they get updates on what that rate looks like, what that payment looks like, and whether or not they still qualify.
So at this point, will you recommend the buyers to stay in touch with the lenders, including you, in a more like monthly basis instead of every 3 or 2 months?
No, I would say, I mean, if they're actively looking, they should be in contact with their loan advisor, every 3 or 4 days or every week as they're looking at properties, because it is important to get updates, and things fluctuate. Rates from yesterday to today are completely different. I mean, it's up over probably 0.3% just overnight.
Absolutely.
So with this current market, definitely need to keep a very close communication.
Very close, yes.
Okay. Now with the market shifting, and obviously buyers need to get a new pre-approval, would you say it's more beneficial or kind of detrimental for buyers to kind of wait for the market to potentially shift? Or do you think they should go ahead and try to purchase now?
I think buyers that are buying for personal residences, meaning something that's going to house them or their family, I think it's important that they find the right property. And I think that anytime you buy for a personal residence is pretty much a good time to buy. It's much different than an investor that's looking to maybe get in and out of a property over a 1 or 2 or 3 year period. Might be a little bit different. He or she tries to time the market a little bit better. But if you're buying for your personal use and something where it's going to house your family, it will gain value over time. You're going to be in that property for a longer period of time. I think that anytime you can buy real estate and get into it is a good time. When you look at the volatility of interest rates currently, rates are temporary. And as we can see day to day, they're temporary, right? So if they get in and the rates are a little bit higher now because of where the market is, just wait 6 months, a year, 2 years down the road, you're going to see lower interest rates. They can refi and take advantage of that, lowering their mortgage. But they want to find the property that is working for them, because that property is a much longer commitment than the interest rate would be.
Absolutely. Thank you for that great explanation.
Thank you. So a lot of people sell their home and now they are renting now. And we have people, they are eager to buy because they are currently renting. So in terms of renting and buying in this current market, how will you as lender and we as agent to helping the client to do that analysis?
So this is something, this is something that we've dealt with in all the years I've been in lending. So going back all the way back into the 80s, we had what they call rent versus buy comparisons that we do. These rent versus buy comparisons since 1987 to this day, consistently over and over and over, purchasing makes more sense. It makes more sense from a tax benefit. It makes more sense from a situation where you have a cap on your housing to a certain degree. Your taxes will go up and your insurance could go up a little bit, but the principal and interest portion of your payment won't go up on a fixed product. So you're really capping what those expenses are. It gives you pride of ownership. It gives you something that you'll have a tangible value or a tangible asset there for you in the long run, and you build that equity. If we look at rent versus buy, almost every single payment that's made, principal, interest, it goes directly back into the property and is pulled back out at the time that they sell the property, or it's accessed when they need cash through equity lines or refinancing or doing things like this. I have never, ever, since 1987, ever seen a situation, even when we went through 2008, these homes that lost a tremendous amount of value, if those people stuck it out for a couple more years, they gained all that equity back, and now look where property values are. So rent versus buy is hands down, especially with rents as high as they are today. Absolutely, buying is the best option.
Thank you. Thank you for sharing that.
Totally agree. Thank you. So when rates are as high as they are currently and a buyer does decide to move forward and purchase, what does a rate buy down look like, and is it beneficial to do so?
So a couple things. If we thought rates were on the rise, meaning that they were going to go higher and higher and higher, then you start looking at buy downs and how does that affect the term and so forth of the cost, the overall cost of the loan. When you look at a current buy down right now, 1 point buys about 0.3% down. So if you took a $650,000 loan, your difference in payments about $149 a month. That time to recapture that money you're spending to buy down the rate, it comes back to you in about 43.5 months. So that means that you're banking on the fact that over the next close to 4 years, that rates are not going to fall below whatever that buy down is that you've purchased as far as rate, that it's not going to fall below that, or that you're not going to need to do some sort of refinancing for home improvement, or that you're going to remain in the house. So those buy down numbers haven't been really beneficial. And most of the clients that I've seen that have just said, I want to buy this rate down, I want this certain rate, they get stuck or fixated on a certain rate, and they've done that, I've seen that it hasn't been beneficial. So I'm not a big proponent of buying rates down. Sometimes we'll see it when we get, we got some ultra low rates, back a year ago, where I had some people buy down on a 15-year. I knew they would only be in it for so long. They would allow them to get this thing paid off in 6 or 7 years. Then it kind of makes sense, but hasn't been a real benefit, especially when we think rates are going to be decreasing in the coming year.
Got it. Okay, that makes sense. Thank you.
So 2023, the rate we're looking at it coming down.
Yeah, I think, well, so the Biden administration has come out and said that we're not in a recession, but the technical explanation or the technical definition of recession is having two back-to-back negative growth quarters, and we've had that. So we are probably right on the verge for a soft recession, because we've got such a high inflationary number. Employment is doing outstanding. The jobs numbers came in double what they expected today. That's what caused interest rates to go up. But with that said, we've got some downward pressure because people have been spending more on fuel and food and everything like this. So they're spending less on all the other stuff, the electronics, the travel, things like that. They've already committed to the travel that they've done this summer, but going forward, the bookings are looking to be less and less. So I think the consumer begins to spend less money. And in doing so, then we'll start to see the inflation numbers come down and maybe a soft landing recession of some sort. And once that starts to happen, you'll see rates drive back down.
Got it.
Awesome. Okay.
Thank you. And then we also have a client asking, we have most of people will take a 30-year fixed rate mortgage, right? And but we have some ARM, adjustable rate mortgage options. When will you advise a client to do ARM or fix?
Well, so 95% of the average Joe public 30-year fixed. And the reason being is that if something goes haywire and goes sideways, as it was in the 80s when we had 13.5% interest, then you're protected. So whatever that number is, as long as we know you can make that payment, then you're going to be safe to be able to remain in the house, and you're not going to go in default. Those that have a more varying income are in a situation where fluctuation of a rate and a payment of a few $100 a month isn't going to put them in default, but they want to take the risk and say, hey, I can get a slightly lower interest rate by taking this adjustable, and thinking that, a year from now, 2 years from now, we're going to see lower interest rates. I could refinance, or I'm going to be in and out of this property in 3 to 5 years. It's not going to matter to me. Those are the people that we would recommend adjustable, or even entertain the possibility of an adjustable rate.
Got it. Thank you. Thank you so much. And then the other quick question is, I know we usually talk about PITIA. There's a lingo, right? The way we talk about it, PITIA. And then I noticed a lot of buyers, when they come to us, or the client come to our open house, or when we sit down with a buyer consultation, even though they probably already talked to the lender or their loan officers, they have no idea about this. Is this something very normal to see that? Like a PITIA, the monthly payment, the principal, interest, tax, insurance, and HOA, if the community has HOA. Have you seen like a lot of lenders that don't explain that part? And what's the reason behind that?
Well, I think, by law, lenders have to explain that. That is part of what we have to quote. Even if we're not impounding taxes and insurance as part of the payment, by law, you have to quote principal, interest, taxes, insurance, any HOA or any, supplementals or association type fees. That has to be given to the borrower in a total number so that they understand what those housing costs are. And under the new laws and the new loan applications and so forth, there's something called the loan estimate that has been given, that has to be given within 3 days of the date of official application.
Yes.
That loan estimate breaks down that payment in categories and lets them know exactly what that number should be. So when they're out shopping, it shouldn't be just a principal and interest number that they're looking at or that they have in their mind, because that's truly not the housing cost. They need to look at a fully encompassed principal, interest, taxes, and insurance, HOA. What is this house going to cost me on a monthly basis, and can I afford it? How does that work within my budget?
Thank you, Mike. You're awesome. So we answered a lot of quite a general question from the buyers, and then we have some regarding the sellers now in this current market, right? So how do we help our sellers?
So sellers have been king for a couple years. I mean, you guys have been, getting 50, 60, 70 offers on every property, and people lining up for open houses and things like this. So, sellers have to realize that the market, that isn't a balanced market. And a typical balanced market, you're going to have the ability as a buyer and as a seller to negotiate back and forth. And have the time to do that. It's not typical that we just line them up and say, okay, the last house in the neighborhood sold for, I'll use round numbers, 100,000, so mine's worth 110 or 120. And you'll have, 50 people lined up that'll pay that. That's not the case. And I think that sellers have to realize that this is a more normal market from perspective of balance. And I think that they have to understand their motivation. If they were just putting their house on the market to try and grab that highest price available, they may not get it. And they have to understand where their motivation is. If the motivation is truly to sell the property, in a market like this where we've got kind of a descending value market, it's important that sellers get out ahead of where the pricing is. And I think that's key. I see oftentimes people will go out and want a price based on what the last comp sold in the neighborhood. Well, in a descending market, that's the old values. They're looking at not what the last guy paid for it, but what am I going to pay for it? And it's usually slightly above that. So if you don't price aggressively, you'll be chasing that down market every time you do a price reduction and you're trying to meet comps that just sold in the neighborhood. You're chasing that down market and never really get ahead of it, and you're never the one that sets the mark. So it's important that you jump out ahead of that and be aggressive with your pricing. Make sure the condition of the property is good and is the best you can make it with staging, as you guys do, which is fantastic, staging and proper photos and all the things you can do. But again, it comes down to really pricing aggressively if that's what you are looking to do, is really to move the property.
Absolutely. Totally agree.
Yes.
Now, in the past 60 days, we've seen a lot more homes be on the market a lot longer compared to these past 2 years, with homes just flying off the market. So how would you say, how does pricing play into the current market conditions as well as housing inventory?
Yeah, and I think that kind of lends to what we just talked about, is just being aggressive with pricing and making sure that you're, again, you're the leader on that, so that you're attracting those buyers that are out there in that neighborhood. You're not the white elephant on the block. You're the one that is aggressive and looks as though you're aggressive and ready to sell. As far as inventories are on the rise, but still very low. So the difference is, and typically when we see buyers back away from the negotiation table, as we saw a fairly sizable reduction probably 4 months ago. There was a couple months there where mortgage applications were down about 80%, 82%. So that's a huge pool of buyers that have since disappeared. So typically in a market, you would see the inventory levels rise pretty rapidly in that type of market. But in this case, and values drop in that market because buyers, sellers have to become more aggressive in their pricing, and doing so, it drives prices down. That hasn't necessarily been the case. We've seen a reduction in prices, but slight. We've seen a more plateauing of values and prices than we have a real true reduction. And the reason being is that the inventories are so tight. The inventories have remained fairly tight, even though 80% of the buyers have kind of stepped away from the negotiation table. So we're still seeing those inventories somewhat tight, which is kind of keeping those values as solid as they can be without seeing the big, downturns like we've seen in the past.
Awesome. That's a great explanation.
Thank you. And the very final questions we have today, it's appraisers. So the first quarter, second quarter, even last year, a lot of buyers, they have to waive the appraisal right. So pretty much they waive appraisal. And so if the bank still was assigned an appraiser out there to appraise the property, and then if the appraisal lower, the buyer still has to pay that difference. Now, of course, a little bit different market now. So when it comes to appraisal, what did appraiser looking at when they see the market? When they see market like this changing, so they're using the comparable, they're using the material calculation cost. What else they are looking at? Are they going to predict the future market to give the value for the current home?
Well, they're definitely looking at trends. So a trend on an upward trend, they're going to be looking at, they take the comparables that have sold, and they're looking at what are properties that are now coming out on the market or pending. What are those pending for? Are they higher than what the average sold or the comparables in the neighborhood, or are they lower? And in this case, when you've got a descending market, many of them are lower or equal to what those were, those comps are. So you'll see that their appraisals be tending in that direction. I haven't really seen where they're really looking at a much lower market. Most of them have been pretty consistent with just a flat market, plateau market, meaning that we're not seeing where, hey, this guy, just because he sold for 100 grand, this one's now worth 110, and he's got 3 pendings in there that are 120. That market now flips and goes the other way, and just shows that, hey, here's where we are at 100,000. Your pendings are 95,000, so therefore we're in a slight descending market to determine value. And I think from an appraisal standpoint, one of the things also I see is condition of the property, and just understanding that feel, as much as we want it to be an impartial, the appraisers are there to value the property, not give their necessarily their personal opinion or idea of what that house is worth just by visual because of the way they feel it, because of the color of the paint or whatever. It's about comps and about similar homes in the area. But it's also about the way that appraiser feels when he walks on the property or she walks on the property. Is it clean, well maintained? Is it staged properly so everything flows? That lends to itself that they're seeing more value, and it's just a nicer atmosphere for them to look at, to create value or create this number of comparables and values and so forth that they're going to come up with for the appraiser.
We just have one question popping in just now from our listener. And what are the major difference between 2008 and now? So
the major difference is skin in the game, is how much homeowners had as far as value or monies invested in those homes. And back in 2008, leading up to 2008, a lot of those loans were, they were 110%, 125% loan to value, meaning that they could come in with no money down and actually pull money out to cover closing costs and all the different things. So they can come in with nothing, no money out of their pocket and end up as homeowners. And you had that. You had on top of that, you had loans that were stated income was, 0.25% difference from a standard loan. So you could get, let's say, a 6% standard loan, or you can go in and just buy that house you really want and say you had, $1,300 a month in babysitting money that was unverifiable to add to your W-2 income. And you went out and bought the house that was $100,000 higher. and that unfortunately you couldn't always make the payment on. So with that, a lot of these people just felt like, hey, my house now decreased in value by 30%, and I'm not going to go and pay. I got to pay 30% plus I had no equity in it anyways. I'm just going to walk away from it. And then that started a perpetuating system where you had in 2008, you had entire blocks in like Fontana, the high desert, that just completely were vacated.
Yeah,
And
I remember that.
so yeah, that's not the case now. Every single mortgage out there, there are stated programs, but they are more geared towards business owners where they're showing bank deposits and they're using bank deposits for income, and they have to have much higher down payments and reserve requirements and so forth, and assets associated with that. Now the programs that are the full doc program, the standard Fannie Mae, Freddie Mac, FHA, those kind of programs, they're all income and asset and everything qualified. So these people are demonstrating that they have the ability to make that payment, as well as they've got some vested interest. They're putting some down payment and some money into this, which I think is a big key difference.
Mike, you are awesome. Thank you so very much for answering some of our clients' questions, and thank you for your valuable time. We definitely will have more questions coming up from other clients,
Thank you,
and we'll
Mike.
put together, and we'll have the next section to share with everyone, and then everyone else out
Thank
here.
you so much for listening.
Thank you very much for
Sounds good.
tuning in.
Thank you, guys. It was a pleasure. Thank you.
Thank you. Thank you, Mike. Thank you.
Bye-bye.
You take care.
Bye-bye.
Enjoy. Everyone stay safe out there. Bye-bye.
Bye, everyone. Thank you.